The question is, what are they going to do, the Federal Reserve, once they hit the January 2022 high of 480? That's their target right now. That's what they're trying to do today, trying to make it all-time new high. And they're having a hell of a time trying to do it. Why? Well, because if you take a look at the 10-year Treasury, it's at just a little bit over 4%. Every time it comes down below 4%, then the tech stocks that they're using to make a new high, they start going up. But then all of a sudden, we go from below 4% to above 4%, and those stocks stop going up. Because remember, tech stocks don't like high yields. They want to see that 10-year Treasury that's now just about 4% go down to about 3% so the market could rally. In fact, that's how we created this whole fake rally from 2008 to 2023. The question now is, once we get to that new high in the next day or two of 480, what are they going to do next? Are they going to start all over again and do another QE for another 14 years? What are you, nuts? You know what inflation would be? So let me explain what they did from 2008, how it works, to 2023, financially engineering the market go up without profits or earnings. And then you're going to understand why the biggest crash is coming. Take a look at my chart. Now again, remember, to move a stock market up, and remember, everything is with the tech stocks. Tech stocks need to have low rates for those stock prices to go up, because tech stocks have a tremendous amount of overhead with research and development. They need to borrow a lot of money, except for Apple, of course. They need to borrow a lot of money. So when rates are low, it's great for tech stocks because it makes them money and stocks go up. So in 2000, now that you know how the market goes up, pretty simple, right? Low rates market goes up, especially tech stocks. They pushed this whole market up for 14 years. In 2008, when the market collapsed after the financial debacle and housing debacle, the biggest banks on Wall Street were insolvent. They're still insolvent today. But what they did is they went in and they propped them up. The Federal Reserve went in and propped them up. So at the time, in 2009, Biden said, and Bernanke, what we're going to do is called QE. We're going to go in and we're going to print money and we're going to buy treasuries to drive the treasury yield down, and then the Fed rate is going to drive their rates down. That's the important one, because that is the rate at which they loan to their banks at night, and then the next morning when they open up their door, then they decide what to charge you for your loan. So that's the important one, the Fed short-term rate. The 10-year is very important because the 10-year also dictates the mortgage rate. The lower the mortgage rate, the more homes we build, and the more the housing market goes up and helps everybody. So when everybody was flat on their feet, the banks couldn't do anything. They couldn't loan anything. They were broke. So here's what they did, QE. They went to the Treasury and told the Treasury, this is where all the inflation started in 2008, right here. Remember, all the inflation that we have today, that is tremendous inflation. People don't realize how much inflation we have or even where it came from. They've been hiding this on us, but I'm going to show you exactly where it came from. So in 2008, the Federal Reserve says to Treasury, print me a whole bunch of money, and then the money went to the Federal Reserve, and then the Federal Reserve went to each bank. So we're going to save you. We're going to buy from you all your treasuries and all your bad subprime mortgages and mortgage-backed securities, and we're going to buy them, and that way you will have your reserves to stay in business, and we'll take all your bad mortgages and all your treasuries and put it on our balance sheet. So we'll take your garbage, you got your money, fresh money, but we don't want you loaning it to the people who are hurting, okay, with upside down mortgages. We don't want you doing that. Okay, we want you taking that money and going out by other banks, go buy commodities, because we want to get your stock up. We need to get your stock up because your stock's almost nothing. We got to get your stocks up. So that's what they did. That's how it started. So in between 2008 and 2012, the stock market started to fly, really started to go up. Because why? Every time they printed money, they buy 10-year Treasury yields, and the yield would go from 5% down to 1%, and the short-term Fed rate would go down to 0, and then they take that money and they go give it to the banks, these big banks right here, and the banks would loan it to all the big companies at 0. And then the companies would take the money and buy their own shares to push their stock price up. What they told us in 2008 was the opposite. They said they're going to take the money and do business investment because that's going to help Main Street. And business investment is going to create jobs. And it's going to create payrolls, and it's going to increase our standard of living and savings, and that's going to grow our economy. Everybody said, that sounds great. By 2012, the stock market was up about 140%. Main Street's looking around, and they're dying. They're saying, wait a minute. We're not getting anything out of this. You promised us it would help us. It was going to trickle down to us. But we're hurting. Look at the price of everything's going up. But everybody, the rich in Wall Street, are getting richer because the stock market's going up. Well, they got worried. Because how could the congressmen start to really get worried? Because they were waiting for their constituency to go and bang on and say, wait, what's going on here, congressman? We went along with this QE, but we're supposed to be the winners. But it's Wall Street that are winners. And inflation's going up. So Hank Paulson and Bernanke and all these people all got together and they came up with the idea, why don't we do this? Let's go adopt what was adopted in 1990 in New Zealand, the target rate of inflation at 2%. Because if we do that, then we have an excuse to tell people that we are going to bring this inflation down for you on Main Street. That's why we're printing all this money and buying all these treasuries to drop the yields so interest rates go down so that we can boost the economy with low rates. People could buy cars and this and that and mortgages. Sounded great, but the problem is the inflation from doing all this. The inflation was so high. So what they did in 2012, they were masking the crime they were committing. People really thought they were ready to catch on in 2012. They didn't like what was going on because they weren't benefiting like they said they weren't going to get benefited. So now they heard, well, we're here to protect you. The reason why we're going to keep printing this money and going buying treasuries, bring interest rates down so that you can buy cars and everything else and think your life's going to be better. But of course not, because it doesn't happen that way. Because when you keep printing money to buy treasuries, the only thing it's good for is pushing the stock market up, but it doesn't create jobs. See, none of that money is going to business investment. Now, if that money was going to business investment, that would have been great. But none of that money was going to business investment. It was going to buy their own shares, to reduce their own shares so their stock price would go up by having profits. But see, people on Main Street, they're close to getting it. But once they put that 2% target in, they said, well, they're on our side because they're fighting inflation. No, they weren't. That doesn't fight inflation. What it was creating inflation, pushing the stock prices up. All they have to do is keep buying treasuries. That's all they've been doing for 14 years. So what happens? That's in 2008 to 2012. Now they put their story in of the Fed target rate. Now what happens, by the time we get to 2018, and I predicted in 2018, in January of 2018, the market was going to correct because there's a problem. There's a repo problem. Now, what's that mean? Well, you see over here, when you keep doing this, keep buying all of their mortgage, and they go get more, and you buy them again. They go give another guy mortgage, and you buy it again. Keeps going on your balance sheet. Well, when the balance sheet started to move up from $950 billion and started to move up to $8 trillion, there's a problem with that. The problem with that is that those mortgages have to be paid off when they come due, and the yields and the treasuries have to be paid off when they come due. But where are they going to get the money from? The Treasury, the Federal Reserve has their dollar income. So the problem was that once they pay that stuff off, those dollars are out of circulation. So what happened is the dollars ended up sinking down to this, from up here, their dollars ended up down here. So in 2018, when the Fed sat down with the banks overnight to give them money so they could lend to each other to open up their doors the next morning, there was not enough money around because they had to keep on paying off all these debts. That's called QT, by the way. So they hurried and got the printing machine going, put all this money back in, okay? And then the banks finally could open up their doors in the morning, and they started the same thing all over again. The loans went back over the Fed, the T-bills went back over the Fed, put on their balance sheet, and then they pay it off again. But in the meantime, inflation's going crazy because that's inflationary every time you print money. So by the time they hit, that was now, let's get up to around 2000, that was 2018. By 2020, remember, Trump became president in 2012. By 2020, COVID hit. It was 2020 when COVID hit. And so Trump became president in 2017. And then you had the repo crash 2018, and then you had the COVID in 2020. Now, the problem was we had all this inflation already. So when 2020 came, more inflation piled on with COVID. Why? What happened then? Well, remember, 2020, we had, with COVID, they sent money, printed all this money, sent it to the business, said, pay all your people so nobody gets laid off. Pay all the people so they don't get laid off. That was all inflationary, of course. So the market, of course, in 2020, COVID, it collapsed. So what did they do? They had to bring rates down to zero to run the market up. So they printed more money, and they used that money to go in and buy stocks. The Federal Reserve and the banks were all buying stock to push the market up, and they pushed stocks down from 2.5%, the interest rate from 2.5% to zero. So everybody jumped in and bought all these stocks, overpaying for them. When 2021 comes now, we got all this inflation going on. Biden comes in, he cuts the oil industry, more inflation. Then he does the American Rescue Plan, the Inflation Reduction Act. He does the Omnibus Bill, green energy, Ukraine. Now inflation is really getting out of control. In 2000, so that's in 2000, and right after he got in 2021. So by the time we hit 2022, we have another collapse. Why? We have so much inflation. All of a sudden, we have the yield curve flip. In other words, the 10-year Treasury is always higher than the short-term Treasury. So let's say the 10-year Treasury is always at 3, and the 3-month Treasury is always at 1. Well, now it's called an inversion because of what's going on. Now all of a sudden the 3-month Treasuries are at 3%, and the 10-year Treasuries at 1%. Well, nobody wants to buy the 10-year Treasuries. They're only 1%. They can now buy a 3-month Treasury and get 3%. Now they got a real problem. So the market crashes down to this October 2022. And one reason, remember what happened? Interest rates went to 5%. So where we are today is this. The inflation, all this inflation is still with us. So remember now, with the inflation that was caused, are they going to now double down? This is what we don't know. This is what we don't know. Are they going to do that to prevent layoffs? Are they going to do this all over again? We have no idea. We got to wait and see. So what we do know is this, that every time, the longer that the inversion of the yield curve, when you have the 10-year lower than the short term, you always have a huge recession and crash. Always happens. The longer the yield remains inverted, where you can now go and get on a 3-month Treasury, you can get interest of 5%, and the 10-year Treasury 4%. That's an inversion. That's very, very bad. So that's where we stand. So this market is probably, now we hit this peak. Remember, the whole market went up all on this crazy QE, and the only way we've been keeping the banks alive for 14 years is buying all their garbage and just keep funneling them money. And so now everything's coming to a head. We're no better off now. Matter of fact, we're worse off now than we were in 2008. So somebody's going to have to make a decision soon. If they don't go back to QE, the market's going to have one hell of a crash. It's impossible not. Do you understand why I'm telling you now? It's impossible not to have a crash. So that's where we stand. So that's the question. What are they going to do once they hit that all-time high? I believe what they're going to do, I say for the next week here, we're going to be testing that January 2022 high maybe 2-3 times. And then if the word gets around, they're not going to go back to 2008 QE and start all over again, then the market's going to collapse. That's when the market will start collapse. Now, they may keep QE going a little bit longer. Maybe they keep it because it's an election year. They can probably do QE a little longer. Inflation keeps going up. But understand what I'm telling you. The inflation, where it's coming from, you can't get rid of this kind of inflation. Remember, this inflation is brutal, where it all came from. First of all, our oil and gasoline, that's not done with. All the programs Biden's doing, all inflationary. All those programs are inflationary. So everything that he's doing is making inflation worse, making our debt and deficits worse. Wouldn't it be nice if somebody would finally just step up in Congress and say, we got to stop this madness. We can't allow another QE, or otherwise I go to the supermarket, and what I used to get a full bag for $100, I'm going to have to pay $800 for it, because that's what this does. Okay, so I hope you enjoyed this. I hope you hit subscribe, like, and share. And try my gang for 10 days. It's free. And we'll help you. See, our gang, we don't care what the market does, because the market goes down, we make money short. The market goes up, we make money going long. We always know the direction of the market. The market's forward-looking. All we have to do is keep reading the bond market. And we designed our own 3 charts that follows money. We don't follow fundamentals. Fundamentals don't work anymore, not in a situation like this, okay? So just try it for 10 days. And I think you're going to say, boy, I wish I did that a long time ago. So that's it. So I hope I explained why we are going to have a crash and it makes more sense to you. See you on the chart.